seconds or minute or whatever, but I want to say welcome. My name is Rich Morrison, and welcome to the NAU Country Connection webinar series. This is our fall edition. We're excited to start back up, and our hope is that these trainings are going to be focused on both our systems and our products that are relevant to crop insurance this time of the year. And to assist you in your sales season, this particular one this morning on margin protection, pretty timely. We're 27 days away from the sales closings, so it's a good time to be discussing some of these topics. If you wish to sign up for additional classes, you can access the information on our news section of our public website at naucountry.com. We have a variety of presenters this time around over the next few weeks. And so we hope you enjoy what we have to offer. And if at any time you have a suggestion on a topic, please share that with us. You can send it to me, send it to our itmarketing@naucountry.com website, email address, and we can hopefully get that implemented. But we think we've got a good selection of different weekly topics that we're going to discuss over the next few weeks. And so we would encourage you to take advantage of that. But my topic this morning is margin protection insurance for the 2021 year. Some of you may be familiar with it, some of you may not. 2018 was the first full year that we had margin protection insurance available, and this will be then the fourth year that we've had this available. And this is for 21, so even though we haven't even harvested the 20 crop yet, we're already talking about 2021 and being able to help our producers manage their revenue risk on their farm for next year. And there's no rest for the wicked, so to speak. I know many of you in Iowa and other areas are busy right now trying to turn in claims and handle the 20 crop year. So the timeliness of the margin protection sales season isn't always the finest, but it also comes at a time where we can help our producers get ready for next year. So with that, we'll kick off. This slide, I don't like to show slides with words, but this is one of a few that I do have. But some of the things, some of the basics on margin protection insurance, it is an area-based product, similar to the RPI and the SCO policies that we've had in the past. Margin protection offers a coverage of levels from 95% down to 70%. The big advantage of this policy, it is the only subsidized policy from the government at the 95% level. And that is a huge advantage, versus RPI at 90%, RP at 85%. And the higher, of course, your triggers are, the more likely you are to ever trigger a payment. So that's part of the reason that this product is attractive. It also has a protection factor. You can buy that from 0.8 up to 1.2. And I'll show you some examples after a bit why that's important, especially in a year like this in some areas of the country. Margin protection has a sales closing deadline of September the 30th. The price discovery period is taking place right now. We're about halfway through, or a little over halfway through the pricing period for all of the products that get priced: corn, soybeans, spring wheat, as well as input costs. And we'll talk about that here in a little bit. Margin protection and RP use the same harvest prices that are set during the month of October for the grains. One thing that's unique about the policy is that you can add an underlying revenue protection policy. So that is extremely unique to this. It's the only policy you can do this. So you can have a county protection with margin protection. You can also have your individual protection with the RP policy. And when you do that, you get a premium credit. The government, and essentially what your RP policy is going to do is pay you on losses on your own farm up to that certain level. Then any additional losses get paid by the margin protection insurance policy. So essentially the RP takes the bottom end off the MP coverage, and to do that, then the government's going to give you a credit, and we'll discuss that a little bit as we go on as well. This is a snapshot, and Alex Mazel in Illinois put this together. Pretty neat history, I guess, of our pricing. But for those not familiar, I wanted to show you which prices are included. And when we look at corn, for example, we have the price of corn, but we also have input costs. And when we talk about margin is essentially taking a revenue policy and subtracting an input cost. And what you're left with is your margin, and that's what you're buying insurance on. And so for margin protection insurance, we use the revenue for the county, we use the county yield and the market price. And then on the input cost side, we use a set of fixed costs that are already set by the policy, as well as these variable costs. And for corn, there are 5 variable expenses, and for soybeans, there are 4. And you can see them on these tables. We have DAP, diesel, interest rates, potash, and urea for corn. For soybeans, we leave out the urea. And when it comes down to it, the fixed costs make up about 2/3 of the overall input cost. The variable expenses that are showing right here make up about 1/3 of it. So then when you look at these, you see that you got 5 pieces of the puzzle that make up the 1/3 of the big puzzle. So each one of these by itself doesn't make a huge difference in the overall input cost. It will make some difference, but in the big picture, it's not huge. And I know that some of us have gotten hung up on this in the past, maybe that what if the input costs change a lot? They would have to change a lot to change the performance of the policy. And so that's the point I want to continue to make, that yes, they do have some impact on the policy. It can be good, it can be bad, depending on which way they move. But ultimately, the policy still boils down to revenue. It still boils down to the yield in the county, and it still boils down to the change in the market price. Where have these things been sold? Primarily Illinois and Indiana. Those have been the 2 big states. I guess I would suggest that the reason is because those states were very familiar with the GRIP policy going back almost 20 years, and now RPI insurance. I think we had more producers in those states that probably used it. We had more agencies in those states that probably sold it and explained it to their producers. And for whatever reason, as you get west of the Mississippi River, it slows down a little bit. Now, I've had people tell me maybe they think it's county size. I don't know, but I would think that if you're a good candidate in Illinois or Indiana for this policy, you'd be a good candidate in Iowa or Nebraska or Minnesota. Basically, if your yields tend to track with the county, if you tend to trend with what the county does year in and year out, then I think you're probably a pretty decent candidate for this policy. And again, another way to think about this is if you can buy the underlying revenue and policy as well and get a credit essentially for doing that, then you kind of alleviate that individual risk as well. So we'll talk some more about that. So here's where it's available. The blue, and this has not changed over the last 4 years, the blue counties are for corn and soybeans. The tan counties in the upper Midwest are for spring wheat and corn and soybeans. The green counties are for just spring wheat only. The yellow counties have corn, soybeans, and rice, and then the orange counties just have rice only. So you can see we've got it out in California in the valley. We've also got it down the Mississippi Valley and along the Louisiana and Texas coast for rice. But the rice sales closing is at a different time. I'm primarily going to be focusing on corn, soybeans, and spring wheat here today. So looking at those maps, zoomed in a little bit more, here's the corn map. So you can see which counties have it, primarily counties that have a lot of information essentially available for corn yields. Here's the soybean map, pretty close to the same looking map. And then here's the spring wheat map. And you can see extends all the way out into really to the mountains, I guess, up in northwest Montana. So my suggestion is that each person on this call likely has at least one producer that you would think would be a good candidate for margin protection insurance. Go back to a couple of the points I made a minute ago. We have 95% subsidized coverage. It's the highest subsidized coverage policy available. If the government's going to pick up the cost essentially of that high of a policy, it's worth looking into. So it only takes a 5% loss in margin to start to trigger an indemnity. So margin, we said, was made up of input costs, it's made up of the yield, and it's made up of price. And so any of those factors that work to make that margin shrink 5% or more would start to trigger a payment. So if input costs go up, if the county yield goes down, if the price of corn, soybeans, or wheat goes down, any combination of ththose, it only takes 5% to trigger a loss. And so that makes it, that gets you as close as you could possibly get to your insurable numbers. It is an area-based product, which some people will argue they don't like, but I would contend that those are good for producers with a yield history that's as good or better than the county average. If your crops are somewhat spread out around the county, if your yields historically trend with the county, all of those factors, I think, make you a good candidate. The base prices are being determined right now. Why is that a positive? Look at the next point. Are you going to farm in 2021? If a producer is going to farm next year, they have risk right now. Some are booking seed right now. Some are, of course, your land is already booked, but you've got fertilizer price risk. You've got diesel fuel price risk. We have election price risk to price. We have a lot of things that can impact what can happen to margins between now and next year. And so if a producer is going to farm next year, then I think this is at least one way we can look at mitigating that risk. We're in the middle of a price rally right now, if you haven't noticed. Prices are at the highest they've been in a few months. Soybeans, the highest they've been since back in the early part of January. Is a producer going to forward sell for next year? If they're not, then what other way do they have to mitigate that risk right now? This is one thing that they can do in lieu of going out and selling grain or locking in their input costs or whatever. This is one way they can at least put a floor under their operation for 2021. So a few other points to consider for this year. RMA will be using the same insurable county yields as the RPI and the SCO coverage. So if you're selling SCO to producers, and even if you don't sell margin protection, you can go out and look at the quotes on margin protection and find out what those county yields have done for 21. So you can kind of get ahead of the game before you get out to February and March. They're also going to be using the same final yields, which is a good thing for accuracy, but maybe not as good for when the payments get made, because those yields don't get released until June 16th. Therefore, it's going to be after June 16th when the producer is going to get a payment for the margin protection insurance. So that's probably the only negative that I see about this policy, is you don't get paid until next summer. Producers can add the underlying individual coverage, and you receive a substantial credit. So the good news there is if you take that individual coverage and you have a loss on your farm, you'll get that payment when it gets adjusted in the fall or in the winter. So at least some of that money will come to you then the remainder of the loss will be paid out into the summer period. And then the last bullet point, producers that must buy an individual policy from the same AIP as their margin protection. You may have heard over the last 2 or 3 or 4 years some agencies being really aggressive that are out pushing margin protection. And part of the reason maybe they're doing that is A, to pick up new customers, but also because that underlying RP policy has to essentially move along. Doesn't have to go to the same agent, but it does have to go to the same AIP, which I think we all really understand is probably going to be the same agent. So in most cases, so this does give you an opportunity to, if you're aggressive, if you're trying to grow your agency, if you're trying to work with some new clients, this gives you an opportunity to go out and speak with those folks now. Maybe their current agent isn't doing that. And so this is a way you can get your foot in the door with some new folks. So I want to start out looking back to 2020, because I think 2020 has been a real poster child for how this policy ought to work and can work. And we've had a lot of volatility in our markets this year. We've had a lot of volatility in 2020 period with the COVID virus and everything else, with trade, with China, with acres, with drought. With duratio now, we've had a lot of different things impact our crops and our markets this year. But these were the starting prices. And by the way, just a quick plug for my market report letter that we send out every afternoon. Generally every day, I will include these updated tables in here with the updated pricing that goes on for crop insurance. So if you don't look at the market report, or if you're not getting it, let me know. We can get you hooked up. But I try to keep track of the prices as we're going through the months. But this is last year's table. And one of the things that was very attractive to margin protection a year ago at this time was where the price of corn and soybeans were. We had the price of corn over $4 a bushel for December of 20 a year ago. We had beans at in the 930s and 940s at that point in time. And my biggest concern a year ago at this time was that we were coming out of a year where we had almost 20 million prevented plant acres. And the fact that in 2020, most of those acres were probably going to get planted to something. And so we were anticipating that this spring we were going to see a big jump in corn acres, a big jump in soybean acres, probably a jump in spring wheat acres as well. So that being the case, there was a reason to believe that prices could get a lot cheaper in 2020. And so that's part of the reason that I was encouraging folks that I visited with to take a look at this policy. Again, if you weren't going to go out and forward sell corn at $4 a bushel, then this was something you could do to at least be able to utilize those prices. So the input side of things, I've showed those on the table as well, and they're up at the top. We've got urea, DAP, potash, diesel fuel, and interest rates. Those are our 5 variable input expenses. Below here, below the table here, I've listed where those are traded or exactly what those are. Urea is FOB the U.S. Gulf or traded on a cash value at the U.S. Gulf. It's a May contract that trades. The DAP futures are a May contract, FOB NOLA or New Orleans, Louisiana. The potash is actually traded on the Amsterdam exchange, but it's at a value at the Gulf of Mexico. Diesel as well, the May contract. The interest rate contract is a 30-day Fed funds rate, and that's a November contract. So 4 out of these 5, everything but interest rates, sets their harvest price, if we call it that, in the month of April. So we're setting base prices right now. We'll set the harvest price for those other 4 in April. Interest rates will get set in October at the same time as the grains do. So, but if you want to try to look them up, Google these, you can do that. I also keep track of these daily in the market report, as I mentioned. We don't see a tremendous amount of volatility in the input prices. In fact, many days, we'll go days, even a week at a time, without a change in some of these inputs. The one that you might notice is potash. And one thing that we've picked up on, potash doesn't ever change. They establish a price at the beginning of this pricing period, and then they leave it alone. So technically, even though they call it a variable expense, it doesn't change. Now they'll set a fall price or a harvest price as well for potash. So there might be some adjustment, but generally speaking, we don't see any changes to potash. So it really only boils down to 4 different inputs that see any change in their values. And as those move up or down, it will impact the policy slightly. But then keep in mind that urea is only a portion of that 1/3 of the variable expenses. DAP is a portion, diesel is a portion, et cetera. This is a snapshot, a screenshot of the margin protection website. If you go to, and I put the heading on here, margin protection, premium estimator, and price discovery. This shows an example of what you could run there. We can also use the NAU country quoter, the Easy Rider as well, and you can run quotes in there. But I've kind of grown used to looking at this one because this is kind of the original source of some of the information. And if I just want a real rough estimate of what premiums would look like, this is what their quoter looks like. But this I ran for Logan County for last year, Logan County, Illinois. And at the bottom, you can kind of see all of the numbers that come out of the quote. In Logan County, their expected county yield was 214.8 bushels per acre last year. When you multiplied that by the 403 base price for corn, came up with an expected revenue of $865.64. The costs came up to, the total expenses came up to $329.16. And I've mentioned this a few times, but the fixed part of that was over $200 an acre. The variable expenses, those 5 variable expenses, then made up a little over $100 out of that $329. So the expected margin was taking this revenue minus the cost, which come up to $536. The total amount of insurance essentially is factoring in the multiplier. And up here at the top, I selected a 120 multiplier. And so I can take my expected revenue times 120. That's basically your liability for the insurance policy. The trigger is taking the expected margin of 536 times 95%. That's how we come up with 493. Then the premium, the unsubsidized premium from the government, is almost $77 an acre on this policy. But after subsidy, a 40+% subsidy, it comes out to $43 an acre. And again, that's just for the margin protection at 95%. We can also be able to check if you want to figure out what the premium credit would be towards this. You can put in your yields or the producer's yields, say for the last 10 years, and it'll calculate the credit. One of the things, and I don't really go into that too much here, but one of the things we've noticed on these credits is that throughout really the core states that have been writing this policy, the credit has been enough to cover the cost for the most part of a 75% policy, and in some areas even most of the cost of an 80% policy. So essentially it's almost like getting a 75% policy for free. And so the producer would be crazy not to do it, at least to have some protection on his farm at a 75% level. And he would then have that 75 up to 95 would be covered by the margin protection. That way, if he had prevent plant, replant, all of those would be covered under the 75% policy. And if he had a 2012 where he just had a disastrous year, he knows that he's going to get some money in the fall or the winter, and then the rest of the money from margin protection would come in the summer of the following year. So go back and look at 2020. We talked about this being a poster child year for margin protection. A year ago, and even all the way up until January, we had December corn futures trading over $4 a bushel. And just about that time, as you got into Jan, Feb, we really, and this is pre-COVID, but we really started talking a lot about acres. What's going to happen to all these new acres this year? And the focus of the trade started to be like, how many acres are we going to get? Are we going to get 92, 93, 94, 95 million corn acres this year? And if you even go out to the end of March, when we had the March planting intentions report, you can see this one day, or the March and then the day after, that the market really dropped hard once we got the numbers from USDA of how many acres they anticipated getting planted this year. And the market kept on going down. Now, part of this drop as you got into April was the COVID drop as well. But we had big acres. We had starting to see reduced demand due to COVID for ethanol especially, but all of those things factored into taking the market down to 3 1/4 a bushel. And you can see these green lines on the right-hand side of the page. I put these on here to really show what the impact for margin protection would be from price. Now, when I talk about price and margin protection, I'm making a lot of assumptions. I'm assuming the input costs stay the same. And at that point in the year, I'm assuming that the yield stays the same, because we don't know what's going to happen to county yields back in March and April. So I'm assuming that, if we have an average crop in the county, if input costs don't move, then I'm really looking at the impact of the price drop on the policy. And you can see when we went to 3 1/4 a bushel, we were almost down 20% from where the base price was set back at 403. Had quite a few producers that I spoke to that had written this policy or that had bought this policy that were really, really nervous getting into spring. Everybody was nervous in spring when the prices went to heck. But at least the people that had this policy in place knew that, as of April, we were essentially in the money for this policy, paying, assuming an average yield for the county and assuming the input cost did move a whole lot. Now, we saw the market sideways for quite a while, a couple of months. We made a new low at the end of June. We had a little spike in early July when we had a first drought scare. Then the markets went back down again, made a new low here in the early part of August. We started looking at some big production estimates, and people were talking record yields and record production of corn. Here we were down more than 20% again here at the beginning of August. And what really happened to a lot of producers this year, we didn't have a selling window. Normally we get a rally in June and July, and you get an opportunity to sell at some better price levels. That rally was 2 or 3 days, and it really didn't get us to very high levels on price. And so a lot of producers haven't sold much, if any, new crop corn for the 20 year. But the guys that had bought margin protection, and ladies, at least knew that they had some protection because of the policy here. Now, what's happened in the last 3 weeks? Markets have rallied. We had the big windstorm across the Corn Belt. We've had drought starting to pick up and started to eat away at some of the crop. So we've seen a drop in the production estimates that have come out. Here the last couple of days, we've seen some yield numbers on corn about 5 bushel below where they were a month ago. In addition to that, we've seen good demand from China that has helped prop the market up as well. So we're not looking at maybe as big of a loss as that we were a month ago, but even so, we're still down about 11-12% on price compared to where we started at. Now, if you bought an 85% RP policy, you'd have to have at least a 15% drop, assuming an average yield, to start to trigger a payment. We're above that level right now. So you can see that at least for the most part around the Corn Belt, and there's going to be areas where we have losses on bushels, I get that. But when you're just looking at price only, the MP policy is essentially in the money right now versus the other policies. Now, we still got another month or so to go before we really dig into the harvest period. We don't know what's going to happen at that point, but at least producers that have this 95% coverage can feel somewhat secure that if the market goes back down, I've got protection from this policy. Maybe now's a good time to be doing some selling because we've had a rally and I need to sell some stuff off the combine. If the market goes down, then the policy's there to help me. The other tool I want to show you is the Agent eVantage website. And if you're not familiar with Agent eVantage, we can get you a password. You can get into this. This is where we have tools like MPowerD and MPowerD. You can get the quotes there for those. But we also have access to this margin protection indemnity calculator. And so here's the drop down. There's also on the right-hand side here, you can see there's a link you can click on there to access the indemnity calculator. But this calculator is a really sharp tool to be able to look at what potential losses might be for margin protection. And the folks at Watson Associates do a perfect job of keeping the input costs and the corn and soybean numbers up to date. These are all as of last night's close. So all of the input costs have been set. You can see on the top right-hand part of the screen, you can see the base prices. You can see the harvest prices. Interest rates have come down for the year, but they haven't been finalized yet. And the corn price hasn't been finalized yet either. It was $3.58 a bushel yesterday when I put the slide together. So what I wanted to show you here is how this tool can work for you and how you can show this to a producer to do some what ifs. And so I ran this again for Logan County, Illinois. I assumed in this first example that everything stayed basically unchanged, that the county yield came in average at 214.8, that the price of corn, as we showed last night, at $3.58 a bushel. Down at the bottom of the page, then, we've got all of our expense information and our margin information. So on the left-hand side, we show our expected input costs, and I've explained this a couple of times, but the fixed costs for this county were $206.90, and then you can see what each of the variable input costs, what percentage or what part of that $329 each of those made up. The final expenses this year went down $13 an acre. And what was somewhat interesting, if you look at these, the urea price, they didn't change it. DAP didn't change. Potash didn't change. Interest is going to drop slightly, but diesel fuel dropped sharply. And if you recall, back in April, when the harvest price is set for these inputs, you remember what happened. We had the COVID outbreak. Nobody drove. Gas prices plummeted. Oil went below $0 for a brief period of time. And so the diesel price went down during that pricing month, which basically took the entire cost or the input side of things down about 3.8% or $13 an acre. So that kind of worked against the margin. But you can see over on the right-hand side then on the bottom right, all of the different calculations that we come up with to determine whether there would be an indemnity payment. And in this example, we ended up, the loss in the county revenue or the county margin was $40.90. But because we had the multiplier, the 120 protection factor, we're going to get paid $49 an acre. So if everything holds still right now, including the price of corn and the county yield doesn't change, this producer is going to get $49 an acre back from his margin protection policy. So I think that to me is a good selling point on this, that things kind of happen the way we thought they could this year in many areas of the country, but because of the price drop, we're looking at being in the money right now if all other things are held constant. What if this county, which I think is going to be pretty decent up in central Illinois, what if they have a pretty good yield this year? What if they have a 220, and so they're up 5.2 bushels? In that example, they'd still get $26.73 back. So, which I think could happen in some areas of the country. What happens what if the price goes back down in the month of October? This rally may be a little overdone right now. What if the market gets a little tired? We start seeing producers selling coming into fall. What if the price of corn goes back down to $3.30? That's still a dime above where the lows were, down around $3.20 a bushel. But if we have a good yield in this county at $2.20 and the price goes down to $3.30, now you're going to get $100 an acre back from the policy. So that's how this thing is really working for the people that bought it in 2020. It's going to take a small miracle not to get an indemnity payment on margin protection this year. Either your county yield is going to have to be way above average, or the price is going to have to rally, or some combination of factors are going to have to take place to not end up getting a payment. I did have a question. Is the margin deductible the cost of the insurance? The deductible? No, the deductible is 5%. That would be from 100% to 95%. So I'd have to do the math. Well, yeah, the trigger margin 493. Yeah, it would. I believe. Well, that's 10%. I'm not sure. I have to do the math on this, but it should be the 5 percentage points from the top end. It should be from 100 to 95. So I'm not sure if the math works out or not. I haven't done the math, but it should work out to where that 5% is at. It's a good question. So let's move on. I went and ran this example for Tama County, Iowa, because I know that up into central Iowa, we've had to deal with the windstorms, we've had drought, and maybe I should have taken a county further west where it's been even drouthier. But I grabbed Tama County, Iowa, to kind of look at an example there of what happens if the county yield drops sharply this year. And so I ran a couple here, and in Tama County, we started out with the county expected yield at 203.8. What if the county yield ends up at 175? And I believe all of these county policies do utilize planted acres when they're coming up with their expected losses. So I think they divide production by planted acres. That hasn't changed from the days of GRIP, from RPI. And so we've got a lot of acres that are getting dissed up right now. And so that, even with the other acres that are planted, all put together, what if yield comes down to 175? And what if the price stays where it's at today? That would be a $358 price. We'd be looking at an indemnity payment of $170 an acre. What if it's worse? What if we go to 150? I said, what if we go to 150 in a county yield and the price goes down to 330? Now you're looking at a check of $327 an acre. A loss of 273 times 1.2 gives you $327 an acre. So guys in that part of the country, I think at this point in time have got to be at least feeling somewhat relieved if they bought this type of insurance, because you've got that 95% trigger. The wind damage was pretty widespread, so it's going to have a big impact on the counties in those areas. Price, of course, is widespread to everybody, so that's going to impact everyone as well. So if we end up with a low yield and a low price, we're looking at a fairly large indemnity getting paid this year. One more, down further on this screen, which I didn't want to narrow it in too much because I wanted to be able to show it. But at the bottom, you can compare RP insurance. Or instead of comparing RP insurance, I said, what if I added the RP policy? So essentially, this can tell you what part of your payment would come from RP and what part of your payment would come from margin. And so I ran the same numbers, and let's assume in this example that my farm's yield was the same at 150 bushel an acre, same as the county. Price is going to be the same as well. This is going to show me what my RP indemnity shortfall essentially is. So this shows me how much less I'm getting from RP than I'm getting from, this is my indemnity payment from the RP policy. So let's say I bought an 80% RP policy and I got most of the premium credit to pay for that policy. I'm going to get $137 in the fall when I do my get my claim worked, and then the rest of the payment, almost $200, will come in the summertime. But that shows the importance, shows me two things. It shows me the importance of having the underlying revenue protection policy to be able to get some money in the fall. And it also shows me how much this margin protection policy is worth, or what the value of that is versus the RP policies. And the highest RP insurance I could buy, I'm only getting $177. I'm going to add another $150 an acre from this margin protection policy. So, there's a lot to be gleaned from this calculator. That's why I like this tool. There's a lot to look at, a lot to compare, and I think it's a good tool to be able to sit down with a producer and do a what if and say, well, what do you think happens if this happens, and then we can be able to see that. I think I have a couple more questions here. Or one more question. It's 5% of your total revenue. Okay, somebody did the math for me. Thank you very much. So that makes sense that is essentially your deductible. So thank you very much. So that brings us to 21. We're in a new sales season, and I think that if I'm going to show the 21, show it to producers for 21, I'm probably going to show examples for 20, because that's the year that we're just coming off of, and that's the year that everybody's it's freshest in everyone's mind right now. So this is the pricing table updated this morning through last night's prices. We've got the corn average up to 379. It's probably going to tick to 380 here in a day or so if the price continues where it's at. Beans are up to 930, essentially back where they were last year. Wheat at 567, which is 16 cents higher than a year ago. But one thing you might also notice, the input costs are down versus a year ago. Urea is running $30 a ton less. DAP's running a little higher. Potash is down. Diesel fuel's down almost 50 cents a gallon, and interest rates are about a point below last year. So even though like on corn, and I'll use corn as my example again, but even though the corn price is down, input costs are down as well. So our margin didn't drop as much as maybe what you might think. And so why am I interested in this for 21? Yes, it's not as high as it was a year ago, but still, when you look at where the market is trading at today, where it's been over the last 3 weeks, we've come from below 360 a bushel on December corn. Now we're trading up into the low 380s. And all of a sudden, that price is a lot more attractive to me. The other thing I talk about a lot with my marketing is some of the technical indicators, like the relative strength index and the stochastics at the bottom of the charts. And both of these indicators, typically the RSI above 70 is a sell signal. It means the market's getting a little toppy. We've run out of fresh buyers. Same with the stochastics lines. And you can kind of look back at history. We haven't been above 70 in the RSI until just recently. But even the stochastics, you can see times where we've taken them up above the green line and then turned over have been times where peaks have been made in the market. Here we are again. Is a producer going to go forward sell December 21 corn right now? I would venture to guess almost 100% are probably saying no to that. I would encourage 380 corn. That's been my target for a while, and I don't think it's a bad place to start doing some hedging. But if you're not going to do that, then this policy is at least one thing you can do to lock in or to utilize that price. And essentially, you're getting a put option is what you're buying on price. And at this point in the year for next year, we don't have a clue what the county yields are going to end up. We don't have any idea what's going to happen with input costs. But one thing we can watch is price. And if we think price is decent and worth defending, then I want to be able to do that. And I can do that within this policy. And by the way, it's a subsidized put option essentially from the government. So that's another thing I like. And it's only a 5% deductible that it takes to be able to trigger a payment. So let's move on. Go back to the margin protection website. Here's the same quotes for Logan County for 21. The county yield was unchanged. One thing I've noticed in looking through quite a few counties around the country, the county yields, I didn't find any that went down, and I found quite a few that went up. So for the most part, they either stayed the same or they increased from last year. And so we go through the math. The expected revenue is $811, not as high as last year, but still not down as much as you might think. costs are down. Last year was $329. Right now we're running $317, so we're cheaper on that side of it, which helps keep our margin about the same or pretty close to what it was a year ago. So the total amount of insurance is 9.25. The trigger is 95% of 494, which is 454, and our unsubsidized premium at $68, subsidized premium at $38. So about $3 an acre cheaper than what we had last year, and that's probably because our liability is down because the corn price is a little bit lower than what it was a year ago. So you're going to save a few bucks on the premium. Here's our look at our easy quote. Same type of quote, same exact numbers. If you're familiar with easy quote, some of you are probably more familiar than I am because it's not something I use every day, but I was able to get in and run a quote essentially a day ago at a $378 price, and you're coming up with the same numbers, expected margin at $494.84. And if we look over on the right-hand side, the quote was $38.37 an acre. So same information. It's much easier to run it easy quote because we've got the producer's history there, and so it's going to link bring all of his history in and figuring out the credit essentially towards margin protection if you add the underlying policy. So let's do some examples for next year. Why do I want to consider this for 21? Well, we had about 5-6 million prevented plant acres this year. Once again, what if we decide to add some of those to corn next year? And if we do that, price of corn could go down again. What if we get a 3.25 next year, starting out at 378? Now you're looking at an indemnity payment of $87 an acre, assuming the inputs and assuming the county yield stays unchanged. So if I'm nervous about price, which I think we probably should have some concern, then this is one tool that I can use, and I keep using the term put option, but essentially it's a built-in put option on price. And if the price drops far enough, we're going to start to get paid something. What if, and this one here, then you can compare it to RP. And if corn goes to 3.25, by the way, 85% insurance will not pay anything if the yield stays the same. So this is one policy that I've got that I can at least make sure that I've got some price protection. 85% is not going to do me a whole lot of good, even at that level, on a drop to 3.25. We'd have to also have an additional drop in yield. So again, part of the reason I really like the policy. What if, so I backed into this one, what does it take in a price drop to start to trigger a payment? If everything else stays the same, I would only have to have a drop of 19 cents down to 3.59 to start to trigger an indemnity payment. So essentially that's my strike price. If this starting price ends up at 380, my harvest price trigger is probably going to be 360. So I can say, in marketing terms, I've got a put option with a strike price of 360. That's the way I would view this policy going into the winter months. And again, we don't know what's going to happen with county yields next year. That's going to affect the payments. We don't know what's going to happen with input costs as well. But this is how I look at it. This early on, it's a price protection. It's a price mechanism, and I can get a 95% subsidized put option. Along with that, I'm getting the bushel protection in case we have a yield loss in the county. I'm getting input cost protection as well. So I think it's a lot of bang for the buck for producers. So that kind of wraps up the part on margin protection insurance. We'll continue to set the prices over the next, 11, 12 days, and I'll continue to update those in the market report. Check those out every day. Let me know if you've got questions, and we'll continue to show those to you. But we also have a tool called MPowerD, and I wanted to show and talk just a minute about it. MPowerD is essentially a price flex product. It allows you to be able to add other pricing periods to your policy. Or even if I wanted to, I could have, prior to the pricing period, actually picked a day and set the price for my policy. I can do this with MPowerD with my corn, soybeans for my February average. If I like the price today for February at 385 and I want to make sure that doesn't get away, I can do that with the MPowerD add-on, and I can lock that in right now. I have a question before I move on. Indemnity does not include premium cost in that is correct. Those were just gross numbers. Those were not taking out the indemnity. You can look at that a lot of different ways. The way I look at it is once you've made the decision to buy the policy, you're really not changing anything at that point. So from then on, I'm looking at how is the policy working for me. I know a lot of producers want to see, well, what's my net? And I get that. So I can see both sides of that. But I figure once you make the decision, you make a business decision to buy the policy, that's already set in place. It's kind of like making your decision to plant a expensive bag of seed corn. Now I'm worried about the yield. I'm not worried about the net between the two. But I can understand why you would look at it both ways. So moving on to MPowerD. Again, go to the Agent eVantage website and you can run quotes on this. This is what the quoter looks like. So I ran this for Logan County, Illinois, again, for the 21 crop year. Same particulars. It's got I guess it doesn't show the yield on here, but I put in 1,000 acres, 95% coverage with a 1.2 factor. Does show the county yield at 214.8. Then down below lists a few other particulars. I can choose my maximum price movement. The maximum I can pick is 50 cents. So essentially, if we start out at 380 December corn, the most I could end up with is $4.30. You can also, there are different things you can add a certain amount of price. You could add 25 cents to the price. If you didn't want to do the averaging, you could just do a certain amount, basically make my base price 405. There's different types of programs, but I'm primarily just looking at the price flex program. I can then pick my periods. You've got a wide selection of periods. I can pick full months. I can pick half months, first half, last half. That's a lot of thinking for most of us. Most of what we've determined over the years that our rallies tend to happen in the summer. So I selected the months of May, June, and July. So if I did this, essentially I've got 5 different pricing windows for my policy now. I've got this September window that we're setting the base price. I've got the May month. I've got the June month. I've got the July month. And then I've got the October month in the fall. So essentially, whichever one of those 30-day windows has the highest average futures price will be the price that I use to determine my guarantee or my trigger for margin protection. I could pick 2-week windows. Some people want to do last half June and first half July. Those tend to be a little more expensive because you're picking a smaller window and it doesn't change. The average can move quicker within those 2-week windows. But here's what the quote looks like. This is the quote sheet. Once you hit show me a PDF of the quote, it's going to show me my 50 cents potentially to the upside. It shows me the other particulars as well. Shows you the maximum liability of 50 cents essentially. And it shows me the cost. Premium estimated $11.37. If you divide that into the bushels in the county, it comes out to about a nickel a bushel, which is a really cheap call option essentially to add to your policy. Then if the average in May, June, or July exceeds this 378 or whatever the base price ends up, you're going to be able to utilize that price. I took out the month of May, just ran a June, July quote. I don't have it on here, but it was about $9 an acre. So you save about $2 and something if you remove 1 month. So the way it works out is each additional month you pick, it's incrementally less increase in the premium. So a lot of people will pick June or July or June and July. Some people might scatter it out, pick a December window, pick a, but the other thing to remember too is if you have the underlying RP policy, that price is getting set in February. So some people may say, well, okay, so I've got this price getting set in September. I got my RP insurance in February. So I've added another month to the mix yet. And if for some reason the February average is higher, then you're going to get that higher price in the RP policy. One thing I have seen historically, and I don't have the table with me, but the margin protection policies over the last 15 years, that August-September window averages on corn between 5 and 10 cents above what the February average is. So that also makes this period a good time relative to the RP policy. So if you're interested in MPowerD, the other thing I learned last week is that we have an extended sales window up until November 15th on this add-on. So the sales closing for margin protection is September 30th. If a producer sees the market move in October, early November, we can decide to add this at some point in time after the margin protection sales closing. So kind of brings me to the end. I did want to throw a plug in as well. This is our commodity market commentary that's available to you, available to all of your producers. If you have producers that you wish to sign up to receive the opening bell phone call in the morning, comes out to you at about 8:37. It's a 2-minute phone blast. What's going on with the markets that day? The market report is the email letter that comes out in the afternoon. We do keep track of all of the crop insurance pricing. The aftermath is my monthly webinar. The next one coming up will be September 14th, where we'll look into the aftermath of the USDA report that comes out on the 11th and its impact on pricing, its impact on crop insurance, FSA programs. So tune in for that. I record a podcast every so often called Kicking Up Dust. You can subscribe to that on Podbean or even go to our website and go to the agent portal and listen to any of those that have been recorded. We also have Crop Scout Insights, which is a bi-weekly offering that we've put together with many agents around the country, agribusiness professionals that send crop scout thoughts and grades on the crops. And then the other one down in the bottom right hand is Revenue Perspectives. And this is a newsletter that I put out usually on Crop Report Day, and we send it to you, and you can personalize that newsletter for your agency. You can put your agency logo on it, put your return address on it. It's meant to be sent out in the mail, but you can also email it to people. So it's one way that we provide the content. You can be able to utilize that to be able to get the information out to your growers. So one other question says, I'm sorry I missed the first part of the presentation. Have you covered how your regular MPCI insurance get a discounted premium if you buy MP? Is there a way to know what is going to be ahead of time? You can run that estimate through our quoter, or you can run it through the margin protection quoter. Either way, you do have to, if you have the producer's yield history, you'll be able to get an estimate of what that would look like. And I did make the comment, what I've seen in the past is, now it's going to be different for every producer, depends on your APHs, and it depends on the variability of your yields over time as well, we've noticed. But if you have, I lost my train of thought there. What we have noticed over time is in most areas of the Midwest, it would be enough to cover the cost of a 75% policy, and in some cases cover most of the cost of an 80% policy, depending on where you're at, your volatility in the yields and that kind of thing. So most producers, I've seen producers at about 85% RP policies in the past that went to margin protection and then lowered their RP down to maybe 80 or 75%. Well, there's still some that leave it at 85% because they want to know that if I have that loss on my farm, I want to get the most dollars I can paid as quickly as I can. So you will get a substantial credit towards 85%. It's not going to be enough to pay for the policy, but it'll pay for a lot of the policy. So there's just a lot of different ways that we can look at it. So with that, this is recorded. So if you missed any of it, you can listen to it again on the recording. So with that, I thank everybody for joining, and I've got my contact information here. This is my email address, rich.morrison@naoucountry.com. You can feel free to call me. This is my work phone, 763-242-2557. If you've got any questions about this, if you want to visit about it, I'm somewhat passionate about the policy because I really see how it works as a marketing tool. That's been my focus. That's my focus with what I bring to NAU is the marketing side of it and how it relates to crop insurance. And these higher coverages really perform well as a marketing type tool. And so that's what I see out of margin protection. And I made this comment early. Yes, the input costs do have some impact on it. But what we've seen over the last 3 or 4 years is they don't have a tremendous impact on the coverage. We've seen a year where a 95% policy essentially gets moved to a 94 because of a decrease in the input prices. So it may affect the policy slightly, but in the end, it still comes down to county yield and price. And right now we're looking at price, and with the rally we've had, I really like the policy. So with that, we'll adjourn. Thank everybody for joining, and hope you have a good sales season, and give me a call or an email if you've got any questions. So, and don't forget to sign up for next week. We'll have another one next Wednesday and of the Country Connections. So thanks for joining.